My name is Justin Rietz, and I'm an assistant professor of economics at San Jose State University. I'd like to first thank MouseBelt for giving me the opportunity to present at this virtual conference. On that note, I apologize for background interruptions as the shelter in place has made it difficult for me to find a 100% soundproof location. My fields of research include monetary theory, the theory of money, and cryptocurrency, a space in which I have been active for over 8 years. Thus, the topic of my presentation is the coexistence and even possible synergies between private blockchain and cryptocurrency technologies and government monies. I'll start by giving a bit of a historical background, the current state of government money, why a government might adopt a digital or cryptocurrency, and finally, the roadblocks, opportunities, and open questions to such an adoption. First, some definitions, as a few key terms have at times taken on different meanings in the blockchain space and in economics. Money we typically define as a generally accepted medium of exchange. I don't think there's anything too controversial about that. Fiat money is a money with an exchange value considerably higher than its commodity value. What I can purchase with a $100 bill is more than what I could purchase with the money from selling the paper and ink that the bill is made from. Legal tender. This is money that may be used to pay public debts, most importantly taxes. Note, however, that I can operate a business in the United States in which I refuse US dollars and accept only, say, Bulgarian lev, and that's perfectly legal. Inflation. Economists typically define this as a general increase in the price level of the average basket of goods your typical household buys. In the cryptocurrency space, sometimes we use inflation to mean an increase in the money supply or an increase in the number of tokens. This isn't how we use it in economics, and the reason for that is that you could have an increase in the money supply, yet at the same time, for a multitude of factors, have a decrease in the price level. Lastly, I'll mention a secondary currency. This is a currency that circulates alongside of or in lieu of an existing money. Sometimes these are called substitute currencies. Other times they're called alternative currencies. Typically, I use the word secondary currency, and this is one of the subfields of my research. So a little bit of history of secondary currencies. There are a multitude of historical examples. In Britain during the 1800s, the government mint wasn't meeting the need for small denomination coins that businesses required to pay workers. Private mint stepped in and minted pennies. And while this was illegal, it was tolerated due to the huge demand. Under free banking systems in the 1700s and 1800s in the UK, Scotland, and the US, among other locations, banks issued private banknotes, typically backed by a commodity such as gold or silver. During the Great Depression in the United States, due to the lack of US dollars in circulation, local governments, business associations, and merchants issued various types of scrip as a substitute for dollars. And there are also current instances of secondary currencies. For example, in states that border Canada, Canadian coins are often accepted at par with US coins irrespective of exchange rates. In Venezuela, communities have created their own currencies in order to avoid the hyperinflating bolivar. In Greece, during its financial crisis, business associations created something called TEMs that acted partly like checks, but partly like banknotes. And perhaps the secondary currencies we're most familiar with are cryptocurrencies such as Bitcoin. So the question comes up, well, why do people use money? This is really a baseline we need to set. Well, the simplified textbook view is that money overcomes the lack of a double coincidence of wants that exists as part of barter. That is, in order for you and I to trade, you have to want the good I have, and I have to want the good you have. Money steps aside from this problem because everyone accepts this generally accepted medium of exchange, and hence it reduces transaction costs that we see with barter. You can imagine if you have multi-party barter, these transaction costs increase exponentially. Okay, so when a national currency, a government-provided money, no longer reduces transaction costs, people will look for other solutions. Okay, academic views on cryptocurrencies have reached, to a certain extent, a consensus. First, their value will be volatile, or their exchange rate in terms of, say, US dollars will be volatile. This is because cryptocurrencies actually typically have, or often have, fixed supplies, whether that's currently fixed or is known to be some fixed amount in the future. Also, it's difficult to compete against the government, which has a monopoly in most places on the issue of currency, and in fact earns money, earns revenue from having this monopoly privilege, and likely aren't going to want to give that up. Finally, US dollars, national monies, have fungibility that cryptocurrencies don't. And by fungibility, I mean that if I'm a retailer and I accept US dollars and it later turns out those US dollars were stolen, I don't need to return those. That's not the case for other types of assets where stolen assets do have to be returned, and currently cryptocurrencies are treated as assets. And many economists also see money as being a public good, and that the only efficient way to provide this public good is for the government to do so. Therefore, many, if not most, economists within the academic world don't view Bitcoin and other cryptocurrencies as valid or useful substitutes to US dollars. So if a country has a well-functioning money and financial system, why adopt a digital or blockchain-based money? Well, even well-functioning systems can be improved. We may want to prevent people from switching to other currencies, at least on the margin. And updates or upgrades to our payment systems, to our money, might help us more effectively implement fiscal and monetary policy. And to a certain extent, it's keeping up with the Joneses. If one government is considering implementing a digital currency, other governments don't want to be left behind. So let's take the US as an example. The US dollar is the international reserve currency. Much of international trade is denominated in US dollars, even for trade that occurs between foreign nationals, or parties or companies or citizens of other countries besides the US. The US dollar is accepted for payment of taxes by US federal and state governments. That gives, to a certain extent, built-in demand for US dollars. So why would the US want to adopt a different payment system? Well, a digital currency or a blockchain currency would allow transactions to occur more quickly and more cheaply. For some transfers between individuals and businesses, it can take over 2 days. And this can also occur if the transaction occurs over a weekend. International remittances are very expensive. A blockchain or digital currency would allow us to reduce the costs of these sort of transactions, though there are private businesses currently working on this. Government transfer payments, such as Social Security, would be much easier. And it would help in the implementation of certain types of monetary policy. So let's think about government fiscal policy. The recent US government economic policy in response to COVID-19, including the CARES Act, has brought to light some flaws. Okay. Disaster payments to individuals are still going out, even after 4 weeks after the program began. Unemployment benefits can take several weeks to receive. Now, in part, this is due to red tape and paperwork, but a better payment system would speed up the payment of these benefits. So we could consider a digital dollar account, perhaps tied to a social security number, that would allow the government to make payments to people almost instantly and would be easier to track. There's also regulatory issues. Kenneth Rogoff recently had a book called The Curse of Cash. Okay. US dollars are currently one of, if not the main payment mechanism used for illegal activities and transactions, such as money laundering. A digital currency would allow the government to track and hopefully prevent such activities. But of course, there's a huge problem that underlines having that power, which is privacy, and I'll touch more on that later. With monetary policy, historically, central banks have implemented policy through targeting a money supply measure or one or more interest rates. And while most of the emphasis is placed on interest rates, the use of monetary injections into the economy are still at least indirectly used, typically in times of crises. Sometimes using money injections is a sledgehammer in comparison to an interest rate target, which is viewed as a scalpel. As I mentioned, in times of crises, though, we're willing to turn towards a sledgehammer if needed. Ben Bernanke, the former chair of the Fed, earned the nickname Helicopter Ben, as he once suggested that there was no reason a country should experience deflation because all a central bank needed to do was drop money from helicopters. Okay. However, in reality, monetary policy works through the financial system. The Fed targets an overnight rate at which banks lend to each other, and monetary injections occur through financial institutions. Helicopter drops are just a nice pedagogical tool. However, if individuals were allowed to have digital bank accounts at the Fed, Fed policy would have a more direct impact on Main Street. For example, we can imagine the Fed increasing or decreasing the interest rate paid on a Federal Reserve digital dollar bank account in response to changing financial conditions, or even making direct digital helicopter drops. There are, of course, dangers with such an approach, but also clear opportunities. So what are other challenges and opportunities specifically in terms of blockchain technology and government monetary systems? Perhaps the biggest challenge is that it isn't immediately clear why a central bank or government would want to use a cryptocurrency versus a centralized non-crypto digital currency. Simplistically, such a system would be a large database acting as a ledger for all digital dollar transactions. And as a society, we already place significant amount of trust in the central bank. And this would seem, therefore, to be the most obvious and simple solution. However, I do think blockchain technology provides some benefits for a government when it wants to provide a digital currency. First, I believe the decentralized nature would make it more robust to attacks, given that there wouldn't be a single point of failure. This also means it would likely be easier to scale and could do so more quickly in response to changes in demand and transaction volumes. Finally, and perhaps most importantly, a government cryptocurrency could allow for digital transactions to still maintain privacy and anonymity to some degree. For example, we can imagine a blockchain in which small transactions, say under $10,000, can be done anonymously, while larger transactions require some type of know your customer restrictions. And if such a system isn't centralized, it would be easier for someone to regulate the regulators. Of course, there are a multitude of legal and technological hurdles we would need to overcome, but I think the benefits could be many. Thank you.